Hello everybody. So today I want to give you updates about 4 stocks. So let's begin and let's talk about GameStop. What happened yesterday with GameStop? GameStop was down 22%. I did not expect this. Actually, the last time I covered GameStop was on the announcement of a Bitcoin strategy, and the stock was up 12%. It seems like the stock, the GameStop, disappointed because it decided to just not buy Bitcoin via the cash on the balance sheet, but it decided to issue a convertible note, a convertible debt. Now, for the short-term investor, that might be disappointing because they were waiting probably for this big buy announcement. But for the long-term investor, actually, I think this is shaping up to be a better decision. Why? Because the $1.3 billion will be borrowed at 0% interest rate. So that's what they will borrow it at, and of course there will be a convertible premium. There will be a premium, and dilution will happen when those converts will convert into stock, and we don't really know how much that dilution is going to be just yet. This happens through the pricing, but in the meantime, at least until 2030, they're borrowing $1.3 billion at 0% interest rate. So that's a good news for the long run. For people trading the stock to the day-to-day, that could have been a bad news. What do I think? 3 things about GameStop. First of all, they went for the converse right away. So this is a pure borrowing of the MicroStrategy playbook. They're following the MSTR playbook at 0%. It's also possible that the stock was down 22% yesterday because the hedge funds are shorting the stock in order to put on the gamma trade. Remember, these convertible bonds are bought for gamma trade purposes, so people buy them because they want to have the option that is embedded in the bonds. They're longer-term options. In many ways, this is when a company issues a convertible bond, it's a way for them to capture that option on their own volatility and turn that into accretiveness. In the case of GameStop, probably buying Bitcoin, and we don't know how much of that $1.3 billion will be used for buying Bitcoin. Hopefully, all of it. When I look at the stock, they have $4.6 billion of cash, $1.3 billion of converts, and who knows if it's going to be upped or not. So that's $5.9 billion total. And theoretically, they turn all of their liquidity and soon to be had liquidity in the form of convert. That would be right now a $9.88 billion market cap with $5.9 billion of quote unquote liquidity. So 1.67 times price to NAV theoretical. It's looking better. It's looking cheaper than it looked 2 days ago in the after hours trading and the after hours market. So if you liked this stock 2 days ago, you obviously like it much more today. For now, I still haven't moved on it. I still believe that the champion is MicroStrategy, and I still prefer the original for now. But this stock is so volatile. Who knows how low it could go relative to how many Bitcoin on the balance sheet? Who knows how good of an entry point we may get? And so if the entry point keeps getting better and better, if we get another few minus 10% days on this one, I would definitely be interested. But it's not there just yet. Now let me cover MicroStrategy. I hadn't had a chance to make a video on the updated number because I was in France, but I'm back in the US now, so you can expect more regular videos. They ended up buying about 1,000 Bitcoin less than I thought they would. They bought 6,911 Bitcoin. Keep in mind, this stock's the volatility is still alive. We had a very nice peak on March 25, closed almost at $242, and this stock right now, with the price to NAV, it keeps going up. The price to NAV now is 1.94x. So long are the days, gone are the days where we could get this stock at a 1.46, 1.48 price to NAV. It is now more expensive than 4 weeks ago. Saylor keeps buying Bitcoin. He seems to be back on the weekly buys of Bitcoin, and we'll know on Sunday if he flashes the buy signal, and the buy signal, of course, for Michael Saylor is this chart from the Saylor tracker where he says, oh, it needs more orange dots, more green dots. Here's my quick commentary on MSTR going forward. I think the ATM on the common stock is mostly done. He still has a few billion on that at-the-market offering authorization, but I think he'll really do it only if the common stock gets overheated, and only if we reach new heights, right? I think right now the main story will be twofold. It will be ATM, doing new at-the-market offerings on Strike and Strife. These are the preferred stock. Strike has a convertible embedded in the preferred stock. Strife has no convertible. Strife is just like a perpetual bond, a bond with no maturity. I think ATMing on both of these new assets will be the main story going forward for Michael Saylor, for MicroStrategy. It will be that story for a while, for strategy, by the way. I should call it strategy now. Converts will be the other big story. Remember, he has about $14 billion left of converts to do, so that will be the other big story. So really two big stories, and possibly when he announces, if and when, and I think he will, but when and if he announces $21 billion ATM program, probably on Strife, when he can do that, because from what I understand, he has to wait a little bit until he can do that, but when he can do that, that may actually be an ATM story on Strike and Strife. That story may actually be a bigger story than even the converts, and it gets very interesting if these bonds get purchased by a lot of market actors, by people who maybe, for example, used to buy things like, government bonds and things like that. Maybe they can buy Strife instead and get money that is backed by Bitcoin and not backed by the US government. And if we evolve to a world, if we move to a world where Bitcoin is more and more prominent, well, you may get into a situation where the yields on these lowers greatly because they get bid up, because people realize, oh well, wait a minute, these preferred, they're over collateralized, I'm very well protected. No financial advice, of course, ever on this channel. Now let me make a commentary on a new stock that I haven't covered. I don't think I've covered it on the channel before, or if I have, it's just really briefly, and it's Carvana. And this was a commenter request. I don't usually do this, but the commenter sent me a nice thank you, super like, and so I figured I would briefly talk about it, but not my long feature video that I do for Patreon, but more like a brief discussion of Carvana. So what do I think about Carvana? When I look at Carvana, well, first of all, I feel like Open Door when I feel about Carvana. They're trying to disrupt the mom and pop seller of used cars, right? The mom and pop used car seller via a fully integrated app and a fully integrated website. Kind of like, Open Door back in the day was trying to disrupt real estate with a single app. And of course, whether it's real estate or cars, these markets have been entirely killed by interest rates. There's no other way to say it. Cars is the same. And if you look at the revenue of Carvana, they've been pretty flattish for the past 2 years, almost 3 years. It's only recently that analysts are now predicting growth again. The same is true for real estate, and that's all about the interest rates. These poor stocks in those expensive items have been battered not because of their fault, not because of a lack of innovation, but because of the macro environment and very high interest rates. So the point number one, as I will say, is tough product. Another point is the volatility. Like I said, it's not for the faint of heart. This stock has been crazily volatile. It was trading in around $8 for like a year, from late 22 to mid 23. It was trading from between $8 and $12. CNBC loved to bash on that stock, saying, "Oh, it's gonna go bankrupt, etc." And next thing you know, it's back at $204. And of course, companies that issue these yielding ETFs, MSTX, you may be familiar, or TSLL, for example, for Tesla, they have caught on to that because, of course, these stocks have very high implied volatility, which means that you get really great option premiums, and so there's this new product on it where people just earn options income. So if you look at Carvana, and if you like Carvana as a potential asset on which to write cash seeker puts or covered calls, or on which to do the wheel, you're an entirely different buyer of Carvana that I think most viewers are on this channel, which is, trying to find a stock that is undervalued, at least for this category of stock that I covered. So let me answer to the question, is the business undervalued? And unfortunately, no. I want to say no. This business is not undervalued. I'm generous, assuming 22% forward revenue growth. The problem, of course, for a business like this, and this is a problem with shares with Open Door, is that the EBITDA margin is so low, the gross margin is so low, and because Carvana, I would argue, is a very well understood business, right? The car business is well understood. It's expensive. I don't understand why these traditional legacy kind of old world auto companies are so expensive, right? I could tell you about AutoZone or O'Reilly, right, in a similar sector. It's like they're so expensive. I think the reason is because they're well understood by the market. Anyways, what am I paying? How much am I paying for that growth? A 0.75. So it's nothing to write home about. The rule of 40, it's a 32. It's fine. It's I don't think this company is going bankrupt anytime soon. If you wrote a cash sticker put and you got assigned, it wouldn't be the end of the world. I don't think this company is bad in any way. I just find valuation expensive. And again, the sector is still a macro-driven sector, and that's when you may say, oh, well, wait a minute. Well, that's a good thing, right? There's going to be tariffs on automobiles, right? There's going to be tariffs on automobiles, so that means brand new cars are going to cost an arm and a leg. So sellers of used cars like Carvana are technically going to benefit because the brand new cars are going to now be much more expensive, and so Carvana is going to be able to raise prices because tariffs are going to have a negative impact and an adverse impact on imported cars and imported parts. And we saw Ford saying something like the F-150 would go up by close to $10,000 or something like that because of tariffs, etc. So that's a narrative. That's a narrative that could drive the stock. But at the end of the day, we're still not April 2nd. The tariffs have not gone through. It seems like the market is now thinking as a consensus that they will go through, and so it may not be just a negotiation tactic. Maybe they will really go through. But then again, if they go through, the question is how long? How long are they going to stay? Right? Are they going to stay on 2 weeks? 2 months? What is it going to be? This is just trading on short-term stuff, and it's a little too risky for me. But make no mistake, I love the business model. This is your classic business model of disrupting the mom-and-pop business, the small auto store, the small used store, the small lot in your little town. That company is going after that small used car lot, and is doing that by having an app, by having the quote-unquote the best cars, or at least the widest inventory of cars. And they acquire their cars. They have their own funnel. They get the cars from Enterprise and Hertz. That's the off-lease cars. They get them from auction. Mannheim is actually the biggest auction. Warren Buffett talks about that company often. Anyways, you have customer vehicles that they get. Of course, whenever someone buys a car on Carvana, they can take the old vehicle, as a trade-in. And so that's the classic funnel. And this is not too different from the funnel that you would find at a dealership, but of course they curate the cars. They have a distribution network where they can sell the cars efficiently across the US. They use data to have better pricing. It's your classic, small mom and pop business going away, being replaced by a highly efficient, highly vertically integrated player with a great UI, with a great customer service. I don't have it on this slide, but they brag about their net promoter score being a 71, which is unheard of. Let's face it. I mean, car dealerships don't have a net promoter score of 71. They just don't. And so that means that people who buy cars with Carvana are very happy with their experience in general. And they have their own marketing and stuff, but you can look at the revenue. Yeah, 21, 22, 23, 24, it's gone nowhere. And that's because of the macro, in my view. But it's a market that's ripe for disruption. I'd be interested to see the difference between a Carvana and a CarMax. That could be a topic for a future video. Let me know what you think. But for me, the stock is too understood by the market, too expensive and too macro-driven or narrative-driven for me to consider adding to my portfolio. But best of luck to you if you like this stock. I think it's a fine company, I'm sure. Finally, let me talk about a stock that I own and that I bought the dip on, and it is CorMedix. So CorMedix is down 37%. Not surprising for a stock that's so thinly traded and that is only 400 million in market cap. Absolutely not surprising. And why is it down? Well, it's down because I guess the guidance disappointed, but I'm very confused because they guided for Q1 and Q2, so H1, right? The first half, Q1 and Q2, they guided between 50 and 60 million. So they guided in 2 quarters, almost 50% more than they did in the entire year of 2024. They guided 50% more than that. And keep in mind, you may say, oh, well, they just started selling in 2024. Well, this was a company that had, a decent valuation when they were pre-revenue too. So to me, they're telegraphing 50% growth over the first half. That's what they're telegraphing. And so when I calculate the analyst number and I end up calculating the growth number based on the analyst expectation, there's 6 analysts following the stock projecting their own revenue number for 2025. I'm getting 180% revenue growth is what I'm getting next 12 months. And so maybe that's a little optimistic, but to me, this is a company that is going to have very easy comps compared to 24 and 25. 25 is going to be, full year with full revenue. And this is also something that I think the market really missed when the market doesn't say, but when analysts and newspapers say, oh, it's the guidance. Well, when I read the guidance, it's from existing customer, and they just finished hiring an entire sales team that's going to go after a new customer. So the 50 to 60 million over the first 2 quarters, which by the way is 50% more than the entire year of 2024, that's only with existing customer, from existing customers. There's going to be new customers added to this base, and so it's to me this is just a classic short-term overreaction in my view, and of course the risks and concern, if you read the call, some people discuss inventory adjustments and inventory levels, but that's fine. That always happens when you don't sell direct to consumer, but the markets for some reason always get scared about that. But they have visibility. The product saves so much money to Medicare. Remember my full video that I made on CorMedix. Medicare spends billions on infections as a result of catheter being not locked, the catheter being open to air, to ambient air getting into the tubes, and then the people get an infection, and that's like an average hospitalization of something like $75,000 or something like that. So this is a money-saving product for Medicare. I don't see risk on that point, and so there's a customer that's getting longer to get on board. And well, of course, these dialysis centers, they're not 2.0 companies. They're old companies. They've been around for a long time. They take their sweet time, right? They have a lot of administrative overhead. Yeah, onboarding delay, of course. Yeah, a lean and mean new company is gonna move faster than an old dialysis center in some region that has been working their way the same way for 30 years, and they need to adapt. And so, anyways, I don't think any of these risks and concerns are valid, at least to the long-term investor. If you're a short-term investor, it's valid, but if you're a long-term investor like me, I don't think it's valid. And I bought the dip. And I'm happy that I bought the dip. And, if it keeps dipping, I might dip a little more into CorMedix because I like the stock. On enterprise value over gross profit over revenue growth, it's a 0.06. My rule of 40 is a 208, although, of course, it's not entirely accurate. Why? Because, I'm saying it's going to do 180% revenue growth. That's obviously not sustainable. That's the early days. But nonetheless, I think this is a stock that's going to remain in the rule of 40 territory for a very long time. I like the product and I like the stock, and I bought this dip. It's a starter position for me. So anyways, none of this was investment advice. This is not financial advice. This is just entertainment. I hope you were entertained. Please like, please subscribe, follow me on Patreon, follow me on X. I am fully back in the US, so get ready for more videos and more of everything from the channel. Thank you so much for watching, and have a wonderful day.